Greetings, everyone, and welcome to the first chapter in income tax. So we're going to go through this. Now, I'm just going to let you know right now, there is just so much information, and don't expect to remember it all. This is definitely one class where you're going to have various notes so you can keep track, or a great way to find the information you're looking for, because there's just no way you're going to remember everything. No, we're going to cover the history and objectives of tax law, the different entities subject to tax and reporting requirements, tax formulas for individuals and who needs to file tax returns, understanding the filing status and some calculations, learning about qualifying dependents, calculating the standard deduction or itemized deductions, looking at capital gains and losses, some internet sources, and e-filing. So there's a lot to cover in Chapter 1, and we're just going to take it step by step. So in 1913, the 16th Amendment was passed by Congress, which allowed the income tax. It has not ever been questioned by federal courts. Now, guys, you're going to hear people try to say the income tax is unconstitutional. It will not hold up in a tax court. We have income taxes so the government can operate. It provides revenues. It does provide economic goals by reducing unemployment. It helps expand capital assets. It controls inflation. And it definitely encourages certain business activities and industries, and also encourages taxpayers to undertake specific social goals. Okay, we're starting right away with the polling discussion. Which of the following do you think is the most important goal of the income tax system? To raise revenues, to provide incentives for certain businesses and economic goals such as higher employment rates through favorable tax provisions, or provide incentives for certain social goals? Well, I think it's pretty much ultimately to raise revenues so the government can operate. Yes, there are other ways that revenues could be raised, but we have found over time this is the best system that we have. Know that most individual taxpayers will file what we call a Form 1040. It contains 3 schedules, Schedule 1, 2, and 3. Schedule 1 has additional forms of income and deductions that are related to figures to arrive at adjusted gross income. Schedule 2 provides with any additional taxes that are required. And then Schedule 3 is pertaining to payments and credits other than withholdings. So there are types of income and deductions that get reported on various schedules. Schedule A is only used to report what we call itemized deductions. Primarily in itemized deductions, you'll see medical expenses, taxes, mortgage interest, and charitable deductions. That's primarily, there's more, but that's what overall is involved in the Schedule A. Schedule B is used to show income, and it reports not only dividend income, but interest income that's above $1,500. Schedule C is a form used when someone is a sole proprietor or self-employed. That is where a person would report the income and the expenses of a business, a self-employed endeavor. This is not when someone is an employee. This is when they are self-employed. Schedule D is used to report capital gains and capital losses. Schedule E is used to report rental and royalty income on page 1 of Schedule E. On the back, on page 2 of Schedule E, pass-through income that is provided to the taxpayer in the form of what we call a K-1 is reported on page 2 of Schedule E. Schedule F is used to report farm income. So those farmers use that to report their income from crops, animals, and then the associated expenses. Now, corporations file a Form 1120-S. Corporations are taxed at just a flat rate of 21%. Certain corporations, called S corporations, file a Form 1120-S. Know that S corporations do not pay income taxes at the corporate level, but they flow that the income to the individual shareholders, and the individual shareholders pay it at their rates. Partnership returns are also similar to an S corporation. They're a reporting entity. They don't pay taxes. So again, that Form 1065 for a partnership or a limited liability company allocates partnership income or losses to the various partners or members. So here's a question for you guys. Which is or are the most appropriate forms or schedules for a taxpayer who receives dividends of $2,000 and does not itemize deductions? Well, we know the 1040 is going to be used because that's the form individuals utilize. The Form 1120 is for corporations. The Schedule B is used to report dividends or interest in excess of $1,500. And a Schedule C is used for self-employed people. So in this scenario, the ones that apply would be the 1040 and the Schedule B. So here is the formula that's used in order to come up with the taxable income and then the taxes for individuals. So we start with gross income. From there, we have deductions for adjusted gross income, and we'll talk about that. But there are certain items that we can subtract in order to arrive at what we call adjusted gross income. From there, we can either itemize deductions or take what we call a standard deduction. We take the adjusted gross income, subtract the either itemized deductions or standard deduction, minus what we call qualified business income deduction, which is a certain write-off based on rental income or self-employed income or income that flows through from a K-1. And then that subtraction then arrives at what we call taxable income. It's that taxable income we look at to determine what the tax rate is. We can use a tax rate or we can use tax tables. You can do one or the other. So we come up with the tax rate, and we then find out what our tax liability is. There may be other types of taxes that an individual may have to pay, such as a self-employment tax. Sometimes there's a tax on health insurance if you underpaid, if you have a marketplace insurance, but I don't want to get too detailed on this. But there's other types of taxes that may apply. After that, you come up with the total tax. Then we figure out any withholdings or tax credits that may apply to a taxpayer. There are various credits, such as a child credit, or there could be an education credit. There are various credits for energy purposes. And we take those credits and any payments that have been paid via withholding or estimated taxes. And from that, we'll figure out if you're getting a refund or if you owe. So this is really an important slide for you to look at that really gives you an overall view of how we determine someone's taxes. So what is gross income? Well, guys, it's pretty much everything unless it's been excluded from income. Basically, what we're going to look at here: wages, interest, dividends, pensions, Social Security, capital gains. That's, in a nutshell, real basic income. So that's what we'll start with. I believe the way the IRS words it is pretty much all income, unless it's been excluded, is going to be taxable. Then there are certain deductions we can take for adjusted gross income. There are certain reimbursed employee business expenses, especially with military, contributions to certain qualified retirement plans if someone is self-employed, any penalties on early withdrawal from savings, and there's, did I say health insurance? There is a health insurance deduction also when people are self-employed. So the gross income minus those deductions for adjusted gross income leads us to the AGI, the adjusted gross income. Here they're saying it can be referred to as the magic line, since it's the basis for several deduction limitations. I'll be honest, I've never heard that before, and I've been doing taxes for 38 years. So it shows there's always something to learn. Now, taxpayers can take what's the higher of the standard deduction or itemized deductions. The standard deduction is shown here. If you're single, the standard deduction is at $14,600. If you're married filing joint, it is double that, $29,200. If you're married filing separate, it is just similar to a single amount. Head of household is a filing status that you are an individual that has a qualifying dependent. That standard deduction would be $21,900. So it's kind of in between the single and the married filing joint. And then there is a surviving spouse, which we'll talk about later, but it's basically when you were married and you have children living with you and your spouse dies, you are allowed to file the status of surviving spouse for 2 years after the year your spouse died. So, various exemptions prior to the Tax Cut Job Act, taxpayers received a deduction called an exemption for themselves and their spouse and their dependents. That was prior to the big changes that occurred. But that has been done away with. Beginning in 2018, we no longer have those exemptions. The exemption amount, which is used for some limitations, such as the gross income test for a qualifying relative, is $5,050 for 2024. So basically, we don't get to write off exemptions as we used to. The gross tax liability is obtained from the tax table or using a tax rate schedule. Tax credits and prepayments are subtracted from gross tax liability to calculate if a taxpayer is going to owe more money or receive a refund. The goal is to break even as best as possible. Who must file a tax return? If you're single and you're under 65, then based on that standard deduction we talked about in the previous slide, if your income is at least $14,600, which is the amount of the standard deduction, if it's under this, you don't have to file. You have to file if it's over $14,600. Once you hit 65, your standard deduction increases. So a taxpayer who is 65 or older, instead of the standard deduction being $14,600, it then becomes $16,550. So for someone who is over 65 and single, generally speaking, there's some other exceptions, but if their income is under $16,550, they do not need to file. If you're married, filing a joint return, and both spouses are under 65, then the combined income, if it is over $29,200, they need to file. If one spouse is over 65, then if it's over $30,750, they need to file. Or if there are both spouses over 65, if their income is over $32,300, they will need to file. When you are married filing separate, it doesn't matter what your income is, you have to file a return. Head of household, again, based on that standard deduction, if you're under 65, $21,900, anything over that, you're going to file. Or if you're over 65, if it's over $23,850, you're going to file. That qualifying surviving spouse is similar to married filing joint, except there's just one person. So the under 65, if their income is over $29,200, they're going to need to file. If that surviving spouse is over 65, then income above $30,750, you will need to file. Guys, you're not going to remember these, but you're going to want to have a good note or where to find this information. So here's something else that's interesting. If you can be claimed as a dependent on someone else's return, you may still need to file a tax return. So if there is a single dependent, they would have to file if their earned income, meaning wages, income from wages, was over $16,550, they're going to need to file. However, if they don't have wages, they have unearned income. If their unearned income, such as interest and dividends, is over $3,250, they're going to need to file. And here it says your gross income was more than the larger of $3,250, or your earned income up to $14,150 plus the $2,400. So if you've got wages and you also have earned income, then you're going to need to file if your earned income is greater than the $14,150 and you have unearned income of $2,400. So there are some unique scenarios, such as if a person is blind, they get a larger standard deduction. There's some other pieces, but for the most part, when a dependent has unearned income and it's over $3,200, they're going to need to file a return. Other situations in which would require you to file, if there are any other special taxes you owe, such as Social Security or tax on tips. If you have alternative minimum tax, which is another type of tax, there is a tax on retirement accounts if you choose to take out a retirement account before you hit the requirements. There can be a 10% penalty tax. There are certain repayments on first-time home buyers back in 2008 and 9, I believe, 2008, where they're having to repay the credits that were given to them. If you or your spouse has received money out of a health savings account, which we sometimes call an HSA, you'd have to file. Self-employment. Now, self-employment is when you do not have a W-2, you report your income on a Schedule C. Here's the catch. If you have more than $400 of net earnings, which means, let's just say you had $500 of revenues, $100 of expenses. So if you have $400 of net earnings from self-employment, you are required to file a return because you have to pay self-employment tax. Since your employer is not withholding the FICA and the Social Security, you're required to do it on your own. If you had wages of $108 or more from a church or qualified organization that's exempt from employer, Social Security, and Medicare taxes, you're required to file a return. This is a little bit unique, but ministers, clergy have a unique scenario where the church does not withhold Social Security from them. They're treated as though they're self-employed and are required to pay that on their own. Advance payments of the premium tax credit were made to you, then you would be required to file. Or if you had income under Section 965. So it's like with everything, there's general guidelines and then there can be some exceptions that would force someone to file. If you file a hard copy, you send it to a processing site. I would say most people e-file their returns. That's just become the standard practice. The return is due the 15th day of the 4th month following the close of the tax year. So the fourth month is April. April 15th is the filing date for individuals. If the 15th falls on a weekend, then it is on that next Monday. Two exceptions. There's a Patriots' Day that if it's a holiday, so then if it's on the 15th, then taxes would not be due until the 16th. And then there's this day called Emancipation in the District of Columbia. If the Emancipation Day falls on a Saturday, then the filing day gets extended if that Emancipation Day is observed on the 15th. So a couple exceptions to why the April 15th deadline is pushed out a day. So if you have some time, you can think about what situation could you be in now where you don't have to file a tax return if you're a single person, or if you're two people of the same age and have the same earned income. Is it possible that one's required to file and one is not? And as you see here, with a single person, if the gross income is under $14,006, generally speaking, you wouldn't have to file. With two people, as you can just see here, there are some scenarios where one possibly would have to file and one wouldn't file. Single status is when you are not married or you are legally separated as of December 31st. The guideline is December 31st. If you were married the entire year that your divorce went through on December 31st, you are then single, even though you were married the entire year. If you're married filing joint, even if you didn't live together the entire year, you can file married filing joint. If your spouse dies, anytime during the year, you still file married filing joint in the year the spouse dies. You may also choose to file married filing separate, where each person files their own return. There are certain guidelines when you are in a community property state, such as Wisconsin or Louisiana, I think California and Nevada also. There are certain guidelines regarding community property states. Head of household is generally when you're single, or you can be married filing separate, but here's the key. You paid more than 50% of the cost of keeping up a home that was the principal place of residence of a dependent child or other qualifying dependent relative. There is an exception to the principal residence requirement if the dependent is the taxpayer's parent. The dependent does not need to live with the taxpayer. Okay? If you are dealing with a child in college, they may be living temporarily at the school. That is another example where you could still file as head of household, as long as you are providing more than 50% of the cost of keeping up the home. If you are the surviving spouse with a dependent child, you can still show that special filing status for 2 years after the death of a spouse. Okay? There are 7 tax brackets. It starts at 10%, goes up to 12, 22, 24, 32%, 35%, and the highest rate is 37%. Now, it does sound high, but guys, back in the 70s, I believe, the highest tax rate, I think, was well over 50%. So guys, if Ricardo's married and has no dependents, in June his wife Katrina leaves him and essentially disappears, what should his filing status be? Now, in this case, it looks like he was abandoned. He is just disappeared. So in this case, he can't file married filing joint. My guess is in this case he would file a married filing separate because he is still married and there are no dependents. Prior to the TCJA, exemptions could be taken, as we talked about previously. No longer is that available. But there are various credits for dependents, and it's important to know about dependents for the purpose of filing head of household. Now, there are so many times that they will change the laws and then those laws will expire. This suspension of exemptions is supposed to stop after 2025, which we'll see what happens. My guess is they're going to extend them. But if that would happen, then chances are that standard deduction that has been increased would be reduced. It's kind of like they find ways of, in this case, they increased the standard deduction and did away with the exemptions. So if they do bring back those exemptions, they would probably reduce the standard deduction. In order to have a child on your tax return, that's called, they qualify as a dependent. In order to have a child dependency, there are 4 tests that must be met. The relationship test, the domicile test, the age test, and the self-support test. If one of the parties is a parent, let's just say a child can meet the dependency requirement of 2 different taxpayers. However, if one is the parent, then that parent gets to claim the dependent. If both parties are parents, but they don't file joint returns, then the parent with whom the child resides for the longer period of time during the year can claim the child. So let's say the child lives with one parent for 8 months of the year, with another for 4. It's the one that lives with the child for 8 months. If they can't determine if it's 50-50, then the parent with the higher AGI, adjusted gross income, gets to claim the child. If there aren't parents involved, then it's going to be the taxpayer with the highest AGI. If a parent can claim the qualifying child but doesn't, the individual with the highest adjusted gross income can claim the qualifying child, but only if that individual's adjusted gross income is higher than the adjusted gross income of any parent that could have claimed the child. Now, know that many people have in their divorce decree guidelines as to who is allowed to claim the child. And the custodial parent oftentimes has to file a Form 8332 that allows the non-custodial parent to claim the child. Owen's 12 years old. He lives in the same house with his mother, Leah, and his aunt, Christina. Under what circumstances would Christina be able to claim Owen as a dependent? Why might Leah and Christina want Christina to claim Owen? So, since Leah is Owen's mom, she has the right to claim him. The tie-breaking rules aren't necessary if the taxpayer who can claim the dependent doesn't claim the dependent. So Christina can claim Owen as a dependent if Leah doesn't. Depending on the income of each woman, it could be advantageous for Christina rather than Leah to claim Owen as a dependent. Now, they have to be a qualifying relative. Well, this is one test, I should say. It can be granted for a qualifying relative who is not a qualifying child based on those 4 tests. So, even though they're not a qualifying child, if they're a qualifying relative, they have to meet these 4 tests in order to be claimed on a tax return. There are benefits of claiming dependents. There are tax credits that can be available, and that basically lowers the taxes on a person's tax return. Again, we've talked about this standard deduction, that this is the amount that taxpayers can automatically take if they do not itemize their tax returns. When you are over 65, your standard deduction increases. And if you are blind, your standard deduction increases. Taxpayers cannot use the standard deduction and must itemize if they're filing a married filing separate return and the spouse itemizes. So if one spouse itemizes and they're filing married filing separate, then both spouses have to itemize. A non-resident alien is required to itemize. And if an individual is filing a short period tax return, they must also itemize. They cannot use the standard deduction. The standard deduction is limited for the tax return of a dependent. The total standard deduction can't exceed the greater of $1,300 or the sum of $450 plus the dependent's earned income up to the basic standard deduction amount of $14,600 plus any additional standard deduction if they are blind or above 65. So this does not apply if we've got a 14-year-old who is a dependent and he's making $20,000 in wages, then he gets the basic $14,600 in a standard deduction. However, what they're trying to say is if the dependent made $7,000 in wages, what they're trying to say here is the dependent's earned income would be $7,000 plus $450 is what the standard deduction can be for that dependent whose wages are $7,000. Okay. Whoops, sorry about that. So basically what they're trying to do here is when a dependent has unearned income, they're still going to be paying some income taxes on that unearned income. So as a child model, 8-year-old Penzer earned $17,000. He's claimed as a dependent by his parents. How much is his taxable income? Well, the $17,000 minus his standard deduction, I think it's a $14,600. So $17,000 minus the $14,600 would be his taxable income. Jeffrey is a 4-year-old and is claimed as a dependent by his parents. He had $6,500 in interest income from a bank account. How much is his taxable income? Well, he doesn't have any earned income. It's all unearned. So we have to go back and look at the standard deduction for this child would be $1,300. So in this case, the $6,500 in interest income minus the $1,300 standard deduction would show that his taxable income would be the difference. Capital gains and losses. Capital gains and losses are involving selling certain assets. So an asset can be stock. So when a taxpayer sells an asset for a gain or loss, the type of asset determines the tax consequences. The formula for calculating the gain or loss is basically the amount realized minus the adjusted basis. The amount realized is the sales price minus any costs that are incurred to sell the asset. And the adjusted basis is generally what you purchased that asset for, plus or minus any types of additional costs for that asset. Most gains and losses realized are also recognized. What that means is if you in fact sell an asset and you receive money from selling the asset, even if you don't use that money, if it just stays in an investment account, you in fact did sell the asset, which means it's been realized. If it's been realized, then you must claim it on a tax return, which means you have to recognize it included in the tax return. So a capital asset is any property, personal or investment, held by a taxpayer with certain exceptions as listed in the tax law. Common capital assets are stocks, bonds, land, cars, boats, homes, items that are held as investments, or items for personal use. Capital gains and losses receive a special treatment if they are held for more than 12 months. If a capital asset is held for less than 12 months, then we call them short-term assets, and they're taxed at ordinary income rates. However, if a capital asset is held for more than 12 months, then there is a special tax rate that is lower for capital gains. There are, depending on the taxpayer's income, there is a 0% tax bracket for a certain income level, and then it goes up as the income increases. No, if a taxpayer is married, filing jointly, and their income is under $94,000, they don't pay any taxes on long-term capital gains. If the income is up to $583, then they only pay 15%. Single, usually everything's half. So if you're single and your income is under $47,000, you wouldn't pay any capital gains on long-term capital gains. You would pay, the rate would be 0. So you can see here the head of household rates and the married, filing separate. So definitely a great advantage when you have capital gains. Now, where people get upset is they say this tax benefit is for the wealthy, because not everyone has the means to have capital assets. So this is definitely a benefit for those that have money. There's two sides to the thinking. One is it's usually those people that have money that also do employ taxpayers to work, and so this is giving them an advantage to be able to invest their assets, so they do have employees. This will be something interesting to discuss in the discussions. Know that if your capital losses exceed your capital gains, only $3,000 of capital losses is allowed per year against ordinary income. And then any carryover capital losses, you carry it over until, if you have only $3,000 a year, you continue to take that until it's used up. The IRS website has a lot of information. Sometimes it is harder to read because the publications can be rather confusing. But you can access the website for basic information. If you want to check your refund, you can look that. You can make a tax payment. There are forms and publications that you can access using the website. The IRS does have YouTube videos that is helpful to understand information. Twitter the IRS has an account there. So there are ways in which to access information for the IRS. I use Lacert. So Intuit offers tax prep products. So I prepare taxes and I use the software called Lacert, which is extremely beneficial because it makes me smarter than I really am. There are tax notes that a tax analyst puts out. I mean, there's all kinds of ways that online you can go to gather information. Artificial intelligence really is an amazing way that information can be obtained. The key with artificial intelligence is that when tax law changes happen, you just have to make sure that the AI is abreast of those changes. Which resource would you go to first for online help or information from the IRS? So, sometimes the IRS website is the easiest one to go to. Electronic filing. Most returns are e-filed. You can use a personal computer and tax software, such as TurboTax, to e-file your returns. I would say probably most people use a paid provider, such as a CPA or a tax attorney. There's also enrolled agents that don't necessarily have those qualifications, but still can file returns. 90% of individuals e-file their tax returns. I know from my office, I am required to electronically file all tax returns unless I just cannot file it electronically. I have a client right now. I cannot get the software to go through because of his unique situation. So as a result, I'm just going to have to paper file his return. Hakeem, age 23, is a full-time student and is not disabled. He lives with Jamal and Halama Carson. Hakeem is Jamal's older brother. Hakeem is single, U.S. citizen, and doesn't provide more than half of his own support. Jamal and Halima are both 21 and file a joint return. So can Jamal and Halima claim Hakeem? Well, guys, I looked it up, and while he meets many of these tests, he doesn't meet the relationship test. Although he's Jamal's brother, he is older than Jamal. The IRS requires that a qualifying child be younger than the taxpayer or the taxpayer's spouse if filing jointly. The only exception is if that child is permanently and totally disabled. Since Hakeem is older than both of the couple, he cannot be claimed as a qualifying child. Now, it says you could explore whether Hakeem qualifies as a qualifying relative, which has different criteria. Here's another case study. Harry and Emily Wells want to know if they can file single instead of married filing joint. They got married on December 30th, and they're like, we want to file single. Basically, they cannot. According to the rules, your marital status on December 31st of the year determines your filing status for the entire year. So since they were legally married on December 30th, they are considered married for the entire year. So guys, I hope this has been helpful. Make sure if you have questions on any homework or any concepts in this chapter that you either email me or you put a note in the discussion for Chapter 1, the ungraded Chapter 1 discussion. Have a good day.